Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Well, welcome to the latest edition of the ASB Investment Podcast. As always, I'm your host, Nigel Grant, and today we're recording our very last episode for 2024. And then now, what sort of is a bit of a tradition, we'll do a year in review show to wrap up what's happened over the past 12 months. We'll reflect on the year that's been, what we've learnt, what's been a surprise, and of course, have a little look forward to 2025 as we weave in a couple of predictions too. And we've got most of the band back together again who were here last time we did it. Today I'm joined by returning favourites. One of them is Head of Asset Management at ASB, Mr. John Smith, and the other is the Head of Multi-Asset Solutions at BlackRock, Mr. David Griffith. How are you both?
Very good. Thank you, Nigel.
Excellent. Thanks, Nigel.
Sounds like it. John, last year I introduced you as the man who always exceeds analyst expectations on revenue and earnings each year and every quarter. From spending pretty much every working day together with you this year, I can assure listeners you've continued to raise guidance. I know this is making you awkward throughout the year as well. What's new in your world and how are you?
This time I'm not going to react to that, but I'm good, thanks, Nige. And what's new in my world? Actually, I wish I had a bit of fun recently with a pigeon. Actually, we have lots of
As one
trees
does.
around our place. Actually, Japanese cherries, and we have wood pigeons, and we have a sick or an injured wood pigeon that my wife has taken under her wing, so to speak.
Very good. Very good.
And they love Japanese cherries, so the Japanese cherry trees have cherries in them. So what Angela's decided to do is actually we go down to the supermarket and buy cherries, and the pigeon loves it. I think the pigeon's decided to take up residence at our place now.
And just for the absence of doubt, cherries aren't cheap.
No, they're not, but that's okay.
Gosh, I feel like it's your very own episode of Country Calendar. And David, it's been a while since we've had you on deck. A yachting reference for you there, which I know you're partial to. You weren't able to join us earlier in the year because you had COVID. How have you been and what have you been up to?
Yeah. Well, thanks for having me again. Great to be here. Yeah, I was really disappointed I couldn't make it over last time. Had COVID and I was actually feeling okay, but obviously didn't want to spread my germs. So
Yes, correct.
decided right thing to do is to not come over. But yeah, good to be here now in the finale podcast for 2024, which is great. What have I been up to? Bit of sailing actually recently.
So I nailed it. It is,
you did nail it.
Okay,
Yes. Yeah, that's right. Yeah.
And avid listeners will remember last time we had you on the show, we had a delightful conversation about the flambomba dessert, if you recall. Who could forget?
To remember the flambomba, yes.
We're catching up for dinner later this week, and in true business speak style, I wanted to circle back on desserts once again, because I know the audience will be hanging out to hear from people. Have you got a favourite dessert highlight from this year?
Ooh, I can tell you what my favourite dessert is. I don't recall a highlight off the
You
top,
go to
but,
wherever, you take the conversation.
Tiramisu is my
Is
favourite.
it?
It is, yeah.
Is it? And
It
John,
is.
do you have a dessert highlight from this year? You'll love this spontaneous question.
This year we had a number of crumbles, actually.
Cherry?
And rhubarb crumble has been the feature.
Okay.
Yeah.
Okay, have you grown the rhubarb yourself?
Yes.
Of course. Mine has been the trifle. Like a good portfolio, it's heavily diversified with multiple layers all working together. I just couldn't help myself.
I knew there was going to be an angle there. Nigel.
Yeah. Now, when I write what we're going to talk about, I can weave whatever I want in. Let's talk about, get to the stuff rather than desserts, right into actually what counts. Markets, and reflect on the year that's been. David, to you first, what stands out to you, I guess, or what will you remember most about 2024?
Yeah, I guess there's definitely been some twists and turns this year. I sort of, was reflecting back on actually last time I was in this room, actually, was back in February. We did a podcast in February. And I was sort of looking at what our key themes were. We thought the key themes would be for 2024. And I remember talking a bit about managing macro risks.
Yes.
And this whole sort of evolution from this period we used to call the Great Moderation, where growth was steady, inflation was low, and moving into this period now with higher macro uncertainty. Basically the global economy driven by supply, inflation sort of being stickier, and sort of get that last mile of getting inflation back towards central bank inflation targets was going to be pretty hard, and that central banks were going to have to be probably a bit more restrictive for a bit longer. So like if I think through 2024, it's kind of played out a bit,
Yeah,
I
bang
guess, where inflation has been sticky. And then in terms of the portfolio, we had a theme around steering portfolio outcomes, being more nimble in the portfolio. And that sort of speaks to some of the sort of, asset classes that we've added in the last couple of years, John, with inflation-linked bonds. As an example, gold is a good example, a good diversifier in the portfolio. So I guess a lot of those themes playing out. And then you've got the bigger, structural themes, the mega forces, digitization, AI. I mean, AI.
Yeah.
I mean, it's just been a phenomenal, ride with AI this year.
And it wasn't a fly-by-night. Like it's still continuing. Yeah,
absolutely. And I think back to the start of the year, there was a lot of discussion and talk around a hard landing in the US. Is it going to be a hard landing, a soft landing, or no landing?
Yeah.
A lot of concerns around recession, and then we look at the actual returns that have the outcomes of markets this year. It's been a pretty positive year. So so it's quite a few surprises, I would say.
John?
I just had a few dot points, I suppose. AI and NVIDIA stood out for me. NVIDIA in particular. I had the Magnificent Seven.
Yes.
It's just lots of conversation about the Mag 7. And then off the back of that, concentration, right? The sense of the US stock market concentrating, and actually the global market concentrating around the US. The US is now 70% of the world. I mean,
of the world market, the
world market.
equity.
It's phenomenal.
Yep.
Then I suppose the election, I was like, there was so much media coverage of the election, but from a market's perspective, like the markets just sort of like worked their way through it. It just wasn't this huge event, I suppose, another thing. Yeah, that would have been it. And it just generally the performance of the US economy and markets versus the rest of the world. I suppose those are the things that
I guess
stood
all the things you've described, it's kind of the markets just, for lack of a better term, took it in its stride.
Absolutely. I mean, you think of some of the returns, the return outcomes. Have a guess, Nigel. What do you think? So gold in New Zealand dollar terms.
Yes. Okay.
You probably know this already. I'm not sure if you've read my script, but you may know the answer to this already.
I may, but for the purposes of the podcast's flow, I will go. I just have no idea.
The return outcome for gold in New Zealand dollar terms to the end of October. How much?
I'm just going to plead the fifth and say back to you. What was it?
40%.
40%.
40%, which is.
I was going to pick 25.
Yeah, it's
a big part of that just sits on the table and
currency.
Absolutely, yeah. Part of it was currency, but a big part of it was the gold price appreciation. Yeah, so totally. For me, like an asset class like that, we would just not expect that level of return from gold. It's sort of. We have gold in the portfolio as a bit of a diversifier. John and I were talking a bit about it a bit earlier. So that outcome is probably one of the biggest surprises, the best performing asset class in the portfolio.
Yeah, and I guess to move on to sort of other surprises, we've talked about gold and that sort of meteoric rise. Anything else stand out to you, David, in terms of other surprises?
Similar to John, like I think the sort of AI theme and how strong that has been. Earnings from NVIDIA, I think just going from strength to strength.
Yeah.
Like sort of mid-year earnings growth was something like 250%.
Yeah.
The most recent earnings round is a little bit less. So it was only 94%.
A mere 94.
94%.
I remember messaging John at some inordinate hour going, John, do you realize that NVIDIA, for example, made more profit in this quarter than like the year ago revenue it made?
Yeah.
Yeah, outstanding.
And then I looked into that and I was like, hang on, wow, that's just amazing. And then you look at it and you actually find out the margins, the gross margin that NVIDIA is making, 70%.
Yeah, and I think its net is like 50 or 40%.
Yeah.
So
what a business to be in at the moment, right? It's just really just making hay while the sun shines, right?
Yeah, and I guess, and also looking at, we'd sort of talked before, the magnitude of the Trump win, David, I guess was something like, I guess it delivered certainty.
Yeah, absolutely. Like I think, like I sort of, through this whole process leading up to the election, I remember we were having conversations around what do we expect and how do you position for it in the portfolio. Our learnings from the 2016 scenario was trying to forecast political outcomes is hard at the best of times. Yeah. And then sort of try to forecast the market return outcomes resulting from that election outcome is even harder. So I mean, heading into this election, the polls were neck and neck, literally 50-50. So I guess we were all probably a bit surprised by how convincing the win was. But then when I look at sort of the return outcomes and at least in terms of our own sort of scenario modeling around the outcomes, we actually modeled it okay in terms of what we thought would happen.
Okay.
Yeah. So that's very different to what happened last time, where all our best thinking and modeling, it was the complete opposite.
Yeah.
So
for the Trump 2016 one,
yeah,
you
correct.
mean?
Yeah. But this time round, we actually, maybe that's because this is the second time round and we could forecast things a little bit better. But it's not perfect, of course. But we were a little bit more accurate in terms of how we thought the outcomes would play out. Yeah.
But I like the way that we anticipated the potential volatility outcomes associated with the election as well. It was like there was times when you thought that actually there could be some outcomes here which could actually end up with some quite negative market like reactions, and so we put on a risk mitigation trade.
That's right. Yeah, we did that quite early too.
And we did it quite early, and that like protected us against the downside at very, very little cost, and it works really, really well for the portfolio. So we sort of like, I thought it was just really, really thoughtful the way we approached the election. The fact that it was a surprise and, it's positives since, well, that hasn't hurt the portfolios. It actually means the option position means we were able to more comfortably hold that position through the election, right?
Absolutely.
And in terms of how sort of, yes, John, you've been talking about that risk mitigation, how we've looked at all those surprises through the year. How's that flowed through to kind of portfolio performance, David? Start.
Yeah, sure. I mean, look, in terms of market outcomes, I think, we talked about gold being up 40%. Global equities are up about 18%. Bond
bad.
markets, both New Zealand and global bond markets up around 3.5%. So if you sort of look at that from a multi-asset portfolio perspective, if you look at the ASB KiwiSaver Balanced Fund, for example, it's up 18% over the last year. And the conservative portfolio is up 10% over the last year.
Not bad, is it?
Some really, really positive, strong returns there.
Yeah, look, I mean, the way I think about that is there's actually some really good long-term lessons to remind people of in that. I mean, it's been a fantastic year, better year than perhaps we expected. But I think it's really useful to sort of like look back to 2022. 2022 was a horrible year. We've had 2 really good years following it. We had some really good years leading up into it. So I think that it's useful to reflect now that markets do go up more often than they go down, but you will get down years. And sort of like if you just extend your view back over a few years and just think about the sort of like the year on years, sure, there was a bad year, but we've had more good years. We're now at all-time highs. We've got some excellent returns. We will have more bad years.
Yes.
But when we have those bad years, let's reflect upon the last few years and be a little bit more sanguine about it, I think, I think that's part of the lesson I think we should take out of this year.
And it's the price you pay for investing. That's just part of the game. When we think about our portfolios, I guess, and what we've done, we've talked about gold, we've talked about linkers as well and their inflation-linked bonds, but in the year we've also introduced a shiny new asset class as well recently, and that is listed infrastructure. David, can you tell us a little bit more about it? And I guess everyone thinks of infrastructure as tunnels and bridges and things like that governments are struggling to fund. But what sort of investments are in this asset class, and why do we think it's a good pick?
Yeah, I mean, infrastructure is a great asset class to own, particularly in this forward-looking environment. It's really the backbone of the economy. We're talking, as you say, like it's utilities, it's transportation, toll roads, ports, airports. Auckland Airport, for example, is in the benchmark for infrastructure, energy, communication networks, cell towers, data centers. So you think of all the sort of mega forces in AI.
Exactly.
Infrastructure is really going to benefit, particularly because data center investment is going to be massive as a result of AI.
It already is, isn't it?
It already is. But the level of investment over the next few years is going to be, I think $700 billion of investment in data centers or something crazy like that over the next few years.
Of course, that needs more electricity, right?
More electricity, so all the utility and electricity providers. And some of the other sort of mega forces around renewable energy and the need for clean energy is going to transform some of those electricity providers. The story around deglobalization, bringing manufacturing back onshore. Yeah, that's going to be positive for railroads and road transport. So some really interesting themes that will play out over the sort of medium to long term.
And when you describe it like that, it's I guess on the news headlines, especially locally here, we're struggling to fund a bridge or a new tunnel or something like that, or a new highway. But it's so much broader than that, isn't it, John? Like the infrastructure it's just so everywhere.
I mean, it's a base set of assets that I think that has been underfunded, underinvested for a long period of time. So if you think about it from just a return perspective, an opportunity perspective, I think there's just so much demand for more infrastructure that it's the longer run, like you can see the longer run sort of like investment proposition that's associated with it, right?
Yeah, it's hard to shift a data center, isn't it?
Yeah, absolutely, and it's I guess in a portfolio context, like we sort of like it for a few reasons, particularly now because valuations are a lot cheaper relative to global equities. Yep. It also has a bit more of a sort of interest rate sensitivity, so
pricing power.
It has it's a bit more defensive. So we think about actually infrastructure. It's the way we sort of think about and model it in the overall sort of multi-asset portfolio. It's what we call a hybrid asset class. Right. So it has characteristics which are growth, but it also has some characteristics which are defensive.
Yep.
So it actually adds quite a bit of diversification to the portfolio. The other thing about these infrastructure assets, a lot of sort of the revenue contracts are tied to inflation. Right. As well, so you do get this inflation sort of protection aspect of
some quite stable revenue streams you get out of them, and so some of the types of assets are actually quite bond-like in many ways, just really generating quite regular returns and revenue streams. So like a really good asset, and so that's the defensive nature of them, but then also still linked to inflation, as you're saying. So the growthy bits to it too.
I mean, this is just because I'm as you know, a nerd about these things, but I haven't asked you or prepared you for this. But what is it the only hybrid asset class? Because that really struck out to me what you said. Or what other ones are considered hybrids?
Yeah, sure. Look, we've got a few. So another example would be high yield, for example. So high yield. So if you purely take the sort of KiwiSaver definitions of growth and income, high yield is an income asset, right?
Yeah, absolutely.
So it would sit on that side of the portfolio. When we are constructing it from our perspective, we try to look through just the high level definitions of what other people think the asset class is. And we actually analyze the return streams and we try to understand the characteristics of those return streams and making sure we're sizing it correctly in the portfolio and it's contributing to either the growth aspect or the income or defensive aspect. And if you sort of decompose the returns of high yield, there's a duration component which sits within the income bucket.
Yep.
And there's also the spread component of high yield, which sits more in the growth bucket.
Right. Okay.
So that particular asset class we think of as a 50-50, so 50% growth, 50% defensive.
So appreciation of the bond price.
Yeah. Whereas infrastructure we think of a bit more growthy, about 70% growth and 30% defensive.
For people who don't really understand what we mean by high yield, I mean a high yield is essentially a bond, but it's a higher risk bond, right? So because
it's a high yield.
It's a high yield because it's higher risk, right? So the yield is high, but because it's higher risk, I suppose, then that's where it gets more equity characteristics associated with it as well. Whereas the really, really low risk bonds, sovereign bonds, have no equity characteristics, straight out bonds. And
I want just before we move into the next section, I wanted to make or sort of reference something that your colleague Ben Powell mentioned yesterday, which has stuck with me since we had a client event yesterday that Ben spoke with one of our investment committee members, Frank Jasper. And so just a quick intervention would be if you would like to come along to those events in the future, just let your ASB Wealth Manager know. But Ben mentioned around the electricity price being the new oil price of the future. And so he thought in the days to come, people will still need oil, obviously, but people will be watching the price of electricity more like they do the price of oil because of all the stuff you've mentioned, data centers and all those things are just going to be so dependent on it. Do you agree? That's
a great. Ben always has these great little catchphrases or things like that. So absolutely, and that's I think about sort of energy prices being old school economy and electricity price absolutely new economy.
And to gold, we've talked about it already. That stellar year it's had, in which the portfolio we've had it in there for risk management purposes, as well as we've benefited very well. Do you still see this as offering the sort of similar characteristics and benefits into 2025?
Yeah, so I think, do we expect 40%, plus returns from gold? No.
Yeah.
Why has gold performed the way it has this year? I think, again, coming into this year, there was some stat around 50% of the world's population was voting in elections this year. So there's a lot of political uncertainty. Obviously, we've had geopolitical uncertainty in the Middle East. And you've got reserve banks actually buying gold and adding gold to their reserves. So they've been sort of the net big buyer of gold in the last sort of 12 to 18 months.
Yeah.
So all that has supported the gold price in US dollar terms. In this year's, I remember last year we had a 3% allocation to gold. We trimmed that a little bit to 2%. I guess we'll review it again early next year when we do the next SAA review. But we're not looking for like a 40% type return from gold.
Yeah.
It has deviated a little bit in terms of if you look at sort of any sort of models that try to mimic or to try to explain the price of gold. The returns have deviated a little bit from what you would normally expect given real rates and the US dollar movements, et cetera. So we probably need to do a little bit more work to understand sort of why those dynamics are there.
Yeah.
But it has been a good diversifier in the portfolio. And we certainly don't expect it to be up as much as what it is, this year. But, a modest, return that's diversifying to growth assets is what we look for from
John,
an asset class.
you always talk to me about it's part of a trifle, if we do a callback to what we talked about dessert-wise, it's part of a diversified portfolio and not everything's going to work at the same time.
Yeah, I suppose that was the point that I was going to make. We get a lot of questions about gold, and it's actually a good one to get questions about because it allows us to talk about. We don't build portfolios out of assets where the focus is simply return, right? Those are the best performing assets. We're looking for a combination of that plus that diversification aspect, right? So an asset which has different return characteristics will act differently to other assets in the portfolio, which is what gold is always a good asset to have in the portfolio. But then, as David says, I mean, when you've had a period of time where it's performed differently than what you would have expected, then you will, in the SAA coming up, you will look at it and say, actually, should we trim it?
So before we move into what the future may hold for markets, just a sort of a quick, what are you most proud of this year?
I'm most proud of how the BlackRock relationship that we established 3 years ago, this long-term view that we really were going to benefit our customers by bringing BlackRock onto the team, is really played off this year. 3 years is the normal period of time where you'd make some sort of assessment of how performance is going, and it's been a great 3 years. Mm-hmm. And I think the thing that I'd also like to remind people is, while BlackRock has lots of relationships in New Zealand, the relationship where they're actually managing their money and are on the hook for performance, and we're getting the benefit of their skill in managing money, is unique to ASB.
David?
Yeah, look, very similar to John, I guess. What am I proud of? The 3-year anniversary and the 3-year numbers now. We're ASB's top quartile over 3 years and since inception. So for me, very, very proud that, BlackRock and the team have been able to help ASB and lifting the return outcomes there. So very proud. Also mentioned, I had a team member in my team this year get promoted as well.
Fabulous.
Yifan Zhao, who works on the portfolios for ASB. So a very proud moment for us and her.
Fantastic.
And so everyone loves a prediction, right? So in markets, just like in life, we know that they don't always pan out, but that doesn't stop people making them or even becoming wedded to them. But everyone knows I love quotes. But as Mark Twain said, what gets us into trouble is not what we don't know. It's what we know for sure that just ain't so. I just love that bit. So it's important to prepare for the range of possibilities that could happen rather than single one out that you're hoping for and I guess, align all your ducks behind it. Looking to the year ahead, David, to you first, how do you see 25 playing out?
Yeah. Look, I think actually, so our BII team got together just recently, actually a week or two ago, and look to formulate the views for 2025. And generally, I think the mood of the BII was pretty upbeat about the outlook for 2025. You've got this backdrop of sort of, I guess, growth is moderating, but we're certainly not seeing any sort of signs of hard landing or recession.
Yep.
Sure, there are pockets of divergence, I would say, across different economies. So in terms of the key themes for 2025, we're still looking for, US to continue to perform very strongly in a relative
still keep
sense.
Going.
So growth, I think overall growth moderating somewhat globally, and growth in the US moderating somewhat, but still the standout.
Still growing.
The standout performer. You've got a good sort of corporate earnings backdrop in the US. The AI theme, broadening out and those productivity gains broadening out to other sectors of the economy. And then, elsewhere, you've got Europe and China in sort of a little bit of a different place. And that actually bodes well for when you see dispersion across economies and sectors. Active management is generally a good thing to have during those periods where you can forecast those dispersions. The other thing I'll mention is around, again, this sort of theme that we've been talking for a while about higher for longer, inflation being sticky, the economy is sort of driven by supply. I would say, Trump's policies generally thought of as being inflationary as well. So that sort of adds fuel to the fire in terms of that sort of higher for longer, sticky inflation story. And we think that has implications for longer dated bond yields. Are investors compensated for taking on that duration risk? So again, that's something that's a feature in the portfolio that we've been positioned quite well for, being in the sort of 0 to 10 year part of the curve.
The belly of the curve.
The belly of the curve. And again, we'll review that when we do the next year's review in the new year. But for now, we think that's a good way to be positioned. And the other thing that we're always thinking about is portfolio diversification.
Good. John, I like that.
In the last, 15, 20 years, this great moderation period, that was an environment where you had the correlation between equities and bonds was quite negative. And that's sort of a period where growth was driving those outcomes. In the environment where inflation is driving markets, that typically results in sort of a more positive correlation between stocks and bonds. So you lose a bit of that diversification benefit that you might otherwise receive from bonds. Yep. So just thinking creatively in the portfolio, what other sort of diversifiers can we build in there? And I think about, again, gold, coming back to gold, we've talked a bit about that, but also the foreign currency exposure in the portfolio as well, along with the addition of infrastructure.
Yeah, I was just going to say, John, what for you?
I'd echo most of the thoughts of David there. I think it bodes well for a year of positive returns. I wouldn't expect them to be quite as strong as this year. I think the things that I'm a little bit concerned the market is actually fairly well lined up in that view. So that
consensus.
Consensus. So that sort of like leaves me thinking the market's a little bit exposed to surprises. And so things like geopolitical risk, I think there's still quite a lot of geopolitical risk out there. There's quite a few conflicts going on, things that could surprise. So that's an area. And maybe sort of like AI profit taking. Mm-hmm. At some point, I think that there's potentially going to be some sort of potentially sharp downside, but people just take profits on the AI theme, which has been running for quite a while. But I mean, that's just going to be a blip in a trend, I would have thought. But
a mega force.
But just be prepared. Be prepared. There'll still be items that will generate volatility. Yeah.
So finally, a topic that our listeners love hearing about, and again, at that client event yesterday, they were certainly asking about it, is the mega forces. We've talked probably over the last couple of years about these. To new listeners, the BII or BlackRock Investment Institute's megaforces are the big structural changes that affect investing now and far into the future. There's 5 of them that BlackRock track. But David, just in the interest of time, what's the one that's kind of on your mind the most?
Yeah, so again, reflecting on this year and how it might pan out going into 2025, I think sort of the theme around digitization and AI is probably one that's sort of front of mind, I would say. And we think of the sort of AI theme playing out across sort of 3 different phases. The first phase is the build-out phase, which is what we're seeing now. So the CapEx investment in data centers, et cetera, I think I mentioned it earlier, it's something like $700 billion is projected between now and 2030 to build out the data centers. That's huge. That's about 2% of US GDP. Yeah. So really big investment there. And that's playing out, over the next 2 or 3 years. And then we've got the adoption phase, and this is where sort of AI, the benefits of AI start to broaden out. So thinking about, who's going to be the early adopters of AI technology. It might extend to healthcare and financials.
So using it.
And then transformation. Yeah. And this is sort of that final phase where you get very broad adoption and those real sort of sizable productivity gains, play out. And maybe that's something that happens, 5-10 years from now. Yeah. But right now we're sort of in that sort of build out phase and then hopefully a bit more of the adoption phase.
John, I'm sure you're right at the zeitgeist of using AI in your everyday life. Have you got any sort of thoughts on, I mean, apart from your comment, obviously, that AI trees don't grow to the sky, is there anything else that's on your mind with that one?
No, not really.
In 5 to 10 years, we'll update you on when John and I are using AI. Might not even be us here. Might be some sort of person impersonating us. We are nearly at the end, so I'm getting to the favourite section. Before we finish up, instead of the usual recommendations that we give listeners on reading, listening, watching, in the holiday spirit, we're changing it up a bit. Perhaps listeners can get some inspiration this time from what everyone's plans are over the summer break. John, to you first. I assume you'll either be skydiving or something equally as heart racing. Is that correct?
Such a wonder. No, not at all. No inspiration really, other than
relax.
Relax. Yeah, I mean, after a busy year, and they're always busy. They're always busier than previous years. It's just relax, right, and just enjoy summer.
And perhaps that wood pigeon can return the favour and give you some treats, I guess.
Yeah.
And David, you're I hear signed up for a very big trip, a social impact sort of thing, thematic to it.
That's right. Yeah, that's right. I do. I have signed up. It's quite interesting. BlackRock runs this social impact program in Asia. We get to visit a country and help them rebuild schools or something interesting like that. So yeah, I signed up for it. We had to write a pitch as to why. It's very competitive.
I bet.
So I wrote my little narrative as to why I would be a good fundraiser for the charity, and using my connections with key clients. Yeah. I'm looking at you and John here.
That's where you pause for a dramatic effect. Yeah.
So I'm going to Cambodia in February, actually, for a week. There's 40 of us, around 40 of us from BlackRock.
Global, 40 around the world.
From Asia, Pac.
Right,
from our offices in Asia. Going to Cambodia, and they've got various different sort of. It's all around providing clean water and sanitation. So we've got 3 key projects that we're going to be helping schools and families with. One is building some bore water, so taps. So digging the bores 25 meters down, hand drilling. So I'm really curious to see how much work that's going to be, and then installing the hand pump.
Yeah.
And we're going to be installing sand filters. So, filtration for, you pour a bucket of dirty water in the top and clean water comes out the bottom. And then the third task is they haven't explained too much about yet, but it's building the toilet block.
Critical.
So absolutely critical. I'm not sure what sort of work that entails, but I think it's just building the actual block around with the brickwork, I think is what it entails. But I'm looking forward to it, and hopefully we help the local communities there and getting clean water, etc.
It's a fabulous initiative. I just like the idea. On one hand, you're helping our customers with infrastructure, and on your trip, you're installing infrastructure.
I'm getting my hands dirty,
You
absolutely.
are literally doing, you're hand building the asset class. What a fabulous initiative. We've had a pretty eventful year on the home front, so we'll just be pottering around home as well, I think, similar to you, John. We're certainly not doing anything as major as that, David. I will be, and I'm trying to get my daughter more involved for the laying the foundations for the family tomato growing competition that I might have mentioned in the past. The random vegetable this year is the beetroot as well. So I have a above ground growing task and below. So and I didn't win last year. So I'm trying to sort of storm back.
Yeah.
Are there any tips to growing a good beetroot?
Look, I have zero capability in the beetroot.
You haven't done the research yet.
Well,
you're really into your research, so you're behind.
Thank you, John.
Yeah.
Thank you. That's a really nice compliment. I will be researching. Last year I had some good success, but I don't know why it happened on the beetroot.
Right.
So I'll circle back. With some feedback in the new year.
Maybe a topic for the next podcast when we see you in the new year.
It's coming back. It's going to do a full episode. That's all we have time for today. So, John and David, as always, thank you for joining us today. It's been a pleasure to have you here, like every time you're here, especially David, thank you for coming over. To our listeners, I hope you enjoy a wonderful little break, however long it is. And we look forward to bringing you new episodes in the new year. In the meantime, thanks for listening in. Have a lovely holiday, and it's bye for now. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.